So you might have been wondering about how it is that some investors can go out, sell a particular home, and be able to pay zero taxes on it. And that is where 1031 exchange comes in, and that is exactly what I want to share with you today in this video. So here we go. Let's assume that you have purchased a particular house like this one, and maybe you spent $100,000. Now, what might have happened over time is that it has gone up to, say, $150,000 in value. Pretty awesome, right? Congratulations. Now, if you were to go out and take and sell this particular house right out, meaning you take out and you collect this $150,000, that means that your $50,000 was considered capital gains. Okay, now what is capital gains? Capital gains basically means that you have achieved some sort of level of success, and you know what government does? Well, what they're really good at and saying, hey, part of that money is our money, thanks to the tax code. So what ends up happening is that capital gains are taxed in a bit different way than ordinary income if you hold the particular asset for longer than 1 year. So if I was to purchase this particular house and say January, and it goes up to value to 150 by June, and I end up selling it and collecting all of the cash, well, that $50,000, which is the difference between what I paid and what I have received on the other end, is going to be considered capital gains and is going to be taxed at ordinary tax level bracket. Now, what is ordinary tax? Ordinary income is basically the income where you trade your time to make some money. And while you might have not have traded any time whatsoever, the way that the government, the way that the tax code is written, it basically says that anything held for less than 1 year, less than 12 months, it has to be at least 12 months or a year and a day in order to be taxed as capital gains. So ordinary income is going to be taxed at anywhere from 10% all the way up to 37%, I believe, is the maximum in 2020 for US based. Now, if you happen to be located somewhere outside of the United States, that tax can be as high as 60%, even 80% in some countries, if you can believe it. So now, I don't get to make the full $50,000 like I have believed. I actually get to make a portion of it. And depending on where my ordinary tax bracket is, depends on what my portion is. Now, let's assume that I held it for at least 12 months and a day, and now I'm looking at anywhere from 0 to 20% on taxes. Okay, 0%, and this again depends on your income. For most real estate investors, they're probably not going to be able to achieve this zero. So it's going to be either 15 or 20% in taxes. Now, you might say, let's assume that it's 20%. You might say, well, 20% is really not all that much money, Nev. Like, right? So, 20% out of $50,000 is going to be $10,000. And while you might not think that that's a big deal, I'm going to show you how this $10,000 is actually valued to you and I $50,000. So when you're thinking of it's not a big deal to pay taxes, I want you to think that it's not just $10,000, it's $50,000. But how is that possible? Now, let's say that I have, I'm going to purchase this home at what is known as 20/80, meaning 20% down, 80% financed, right? So 20% of $100,000 is $20,000, yes? Right? So if I was to take $140,000, right? So say that I took this money and I sell the property, I pay my $10,000 in taxes. Now I only have $140,000. $140,000 will buy me $700,000 worth of property. Not too shabby, right? Especially if we're using this 20/80, right? But if I don't pay that $10,000 income, or the $10,000 tax, sorry, I have $150,000 to invest, which gives me a property or a couple of properties at $750,000. It's a simple math that ends up working out when you calculate it. So if you have a calculator, if you have a phone, you can simply calculate this and check my math. This is why it's really important to look for ways to reduce your expenses, and taxes end up being one of the biggest expenses that you and I and all of the investors all over the place have. Our job, our goal is to legally and ethically reduce those taxes. Now, I'm not saying don't do it legally. Don't do something shady. Make sure you work with qualified tax professionals that can help you maximize your returns. But here I want to explain how investors can sell something at $150,000 and get the whole $50,000. So instead of buying $700,000 property, they can purchase $750,000 property. And that is where 1031 exchange comes in. Now, let me clear the board so that I can explain more. So, let's say that I do have this property and it's now valued at $150,000. Instead of sending it straight out and collecting that money, putting it into my pockets directly, I use what is called a 1031 exchange agency. Money goes to them, it does not go to me. They hold on to this money for me, in my benefit. I am the beneficiary of that money. Now, here's what ends up happening. They will take this, and because I'm using them to be able to purchase this, the tax code allows me to legally keep all of the proceeds of the money, and then when I find a new property, I am able to use the entire thing to purchase it. And maybe instead of a single family, I find a duplex, triplex, or maybe even an apartment community, and all of a sudden one home turns into many. And that is how real estate investors, intelligent investors, are able to maximize on their profits and appreciation. Now, instead of collecting one paycheck, I might be collecting 2, 5, maybe even 20, depending on where I'm buying and what I'm buying and what the current prices are. Now, how do we prepare for 1031 exchange? Well, it's pretty simple. When I know that I'm going to list a particular property for sale, I'm going to start considering of where exactly I'm going to invest in, and I'm going to start looking. I'm going to start paying attention to what's happening. Now, I don't know if I'm going to take 1 month to sell this or 2 years to sell this particular property, but I know that it's going to sell, and I know that I'm going to use 1031. I located 1031 exchange agency. There are multiple out there. Just simply look for it online. Make sure you read the reviews and understand exactly what their fees are, because it is not free. But you know what? I'd rather pay $1,000 or $2,000 for them to do this and preserve $50K as opposed to pay $10,000 in taxes and lose that $50K of investment. Fair? So that's what I end up doing. I prepare for it by knowing that I'm going to sell this, and I know roughly what I'm going to get. So if I know that it's valued at $150,000, I'm going to go out and find what I can purchase for $150,000 down payment. Meaning I'm going to use this $150,000, okay, as a 20% down, and I'm going to finance 80% of it. Now, I just did the math earlier, and I know that I can go out and start looking for properties that are worth at $750,000 in order to fit this particular math. I'm going to need to have a little bit of money for the fees that are associated with purchase and sale. So I may not get the whole 150, so I'm going to account for that. And because I'm purchasing something, I might not buy the whole 750. It might be a little bit less. Or if I happen to have some cash aside, which is what you should have, then I can cover all of those expenses and use all of the proceeds to get the property. Now that I know that I have $750,000 to play with, I'm going to go out there and start searching, have a few different deals out there so that when the sale happens, I can move pretty quickly, because this is all contingent on a timeline, and you want to make sure you pay attention to that. I hope this was helpful to you and that next time you decide to sell your property, you will consider doing a 1031 exchange to preserve your money. If you have enjoyed this, please share it with others, like it, comment, and make sure you come back. Until next time, stay forever money blessed, and do remember, you are only one deal away.
I want you to be happy. Don't you want to be happy? I want to be happy.